Friday, the 26th of July 2019. I'm Steve Towers. Welcome to ITV. Let's get started. The French digital services tax has now been signed into law by President Macron. It imposes a 3% levy on revenue derived from specific digital activities by companies with qualifying group revenue of more than 750 million euros globally and 25 million euros in France. It's effective from the 1st of January 2019, and the first payment will be due in November. For a copy of the final law, please go to our website or app. Meanwhile, countries are busy crunching numbers to estimate their revenue costs or benefits from the various proposals in the Inclusive Frameworks digitalisation project. For example, press reports in Switzerland indicate that that country could lose up to $10 billion annually under the Pillar 1 proposals. The Japan-Korea trade conflict has become a real concern for consumer electronics supplies around the world. It started early this month when Japan imposed export restrictions on certain industrial materials which Korea needs to manufacture semiconductors and display screens. The Wall Street Journal reported today that Tokyo is considering broadening the trade curbs as early as next week for roughly 1,000 more Japan-made products that flow into South Korea. That would cover virtually every product Japan ships to the country. Few anticipate a quick resolution. And the reason for that is that the conflict is not based on trade matters, but instead on the long history of animosity between the two countries. For the Japanese government's information about the export restrictions, please go to our website or app. Well, first there was LuxLeaks, then the Panama Papers, and now we have the Mauritius leaks. The ICIJ have suddenly discovered the double tax treaties entered into by Mauritius with African countries and are asserting improper tax avoidance. Well, that's a debatable conclusion. Improper tax avoidance or encouragement for inbound investment into African countries? You can make up your own mind. For the link to the ICIJ's website, please go to our website or app. The Inclusive Framework has published an updated report on peer reviews for BEPS Action 5 in regard to harmful tax practices. For the first time, the peer reviews cover 12 no or only nominal tax jurisdictions. For a copy of the updated report, please go to our website or app. And the USCIB, a business group, has written to the UN Transfer Pricing Subcommittee giving feedback on two aspects of the draft update to the UN Transfer Pricing Manual, on debt versus equity recharacterization under Article 9 and on the profit split method. For a copy of the USCIB letter, please go to our website or app. In Australia, the tax authorities have issued guidance on the thin capitalisation rules. The guidance explains the types of deductions which are subject to limitation under the thin cap rules. Of course, this includes interest, but it also includes other costs which relate to the relevant debt, such as advisory fees and bank charges. For a copy of this guidance, please go to our website or app. Also in Australia, the tax authorities have issued guidance on the operation of the so-called anti-churning rules in the tax consolidation regime. For a copy of the guidance, please go to our website or app. And another one from Australia. The tax authorities have issued 2 related items of guidance in regard to the meaning of the term structured arrangement, which is used in the hybrid mismatch rules. For a copy of the 2 items of guidance, please go to our website or app. And finally, in regard to Australia, the tax authorities have corrected the technical error in the recently issued guidance on the interaction of the transfer pricing rules and the debt equity characterisation rules. For a copy of the correction, please go to our website or app. In Hong Kong, the tax authorities have issued 3 items of guidance in regard to transfer pricing. The first is DIPN 58, which deals with TP documentation and CBC reports. The second is DIPN 59, which deals with substantive transfer pricing issues. And the third is DIPN 60, which deals with attribution of profits to PEs in Hong Kong. For a copy of these 3 items of guidance, please go to our website or app. In Indonesia, the government has issued a regulation which makes a significant change to the country's CFC rules. The change is effective in the 2019 tax year. Prior to the change, all items of income, regardless of whether active or passive in nature, derived by CFCs, were deemed as dividends to the Indonesian shareholders. However, under the new regulation, only certain types of passive income will be deemed as dividends. Other types of passive income and all active income will not be caught by the CFC rules. These are the types of passive income which will be caught by the CFC rules. Dividends, but excluding dividends from other CFCs. Interest, but excluding interest received by a CFC which is owned by an Indonesian bank, subject to an anti-avoidance exception. Rent from related parties, royalties, and gains from the transfer of assets. For a copy of this new regulation, please go to our website or app. In Vietnam, the government has released for public comment a draft decree for a preferential tax regime for the National Innovation Centre, NIC, which will be constructed in Hanoi. A number of tax incentives will be available for technology companies which are licensed to operate in the NIC, including a concessional 10% corporate income tax rate for 30 years. Public comments are requested by the 15th of August. For a copy of the draft decree, please go to our website or app. The European Court of Justice has decided a case referred from Portugal in regard to the EU Merger Directive. The case concerns GPN, a trading company incorporated in Portugal. Another company, Exco, was incorporated in Portugal for the purpose of acquiring all of the shares in GPN, which it did. Exco financed its share acquisition, in part, by a third-party loan. That gives us the structure shown on the left side. If nothing else then happened, Exco's interest expense would have been deductible under Portuguese tax law. However, Exco and GPN then entered into an upstream merger, with GPN as the surviving company. The merger resulted in Exco ceasing to exist. and Exco's liability to the lender now being owed by GPN. That gives us the structure as shown on the right side. Under Portuguese tax law, GPN's interest expense is not deductible. The question which was referred to the ECJ by the Portuguese court was whether the denial of the interest deduction to GPN breaches the EU merger directive. You'll note that I said that both companies involved in the merger, GPN and Exco, were incorporated in Portugal. There was therefore no cross-border element in the merger, and therefore the EU merger directive does not apply in this situation. The Portuguese court knew that. However, it explained that the tax treatment in the EU merger directive has been extended by Portuguese national law to purely domestic mergers. And it's for that reason that the court referred the question to the ECJ. And the ECJ, despite protest from the European Commission and 2 other member states, agreed to answer the question. And the answer given by the ECJ is that the EU merger directive is silent on the point. It is therefore within the discretion of the member states to determine in what circumstances the interest expense would be deductible. So that means that the Portuguese law, which denies an interest deduction for GPN after the merger, does not breach the EU merger directive. For a copy of this case, please go to our website or app. The EFTA Surveillance Authority has published a report on the private enforcement of state aid rules by national courts in the 3 EEA EFTA states, Iceland, Liechtenstein and Norway. For a copy of the report, please go to our website or app. The European Commission has published an updated list of VAT cross-border rulings, with a total of 22 rulings. For a copy of this document, please go to our website or app. The European Commission has published the 2018 statistics for MAP cases and APAs within the EU. The MAP numbers are limited to cases between 2 EU member states. They don't cover cases with third countries. For a copy of the 2 reports, please go to our website or app. And it's been reported that the Commission will appeal the European General Court's decision in regard to the state aid case concerning Poland's progressive rate retail tax. In France, the tax authorities have issued guidance on the operation of the IP tax regime, which has operated since the 1st of January this year. For a copy of the guidance, please go to our website or app. In Greece, the new government has announced major tax cuts, including a reduction in the corporate income tax rate from 28% to 24%, a reduction in the dividend withholding tax rate from 10% to 5%, and reductions in VAT rates. The reduced rate will fall from 13% to 11%, and the standard rate will fall from 24% to 22%. In Ireland, the tax authorities have issued guidance on the operation of the CFC rules, which are effective from the 1st of January 2019. For a copy of the guidance, please go to our website or app. In Portugal, Parliament has enacted a law which amends the country's transfer pricing rules. The key change is the removal of the hierarchy in selecting the transfer pricing method. Also, taxpayers will be allowed to use other methods for transactions with unique characteristics or where there is otherwise a lack of data on comparables. In the UK, The High Court has decided a case on EU state aid. The case concerns the bank payroll tax, BPT, which was a short-term tax imposed in the wake of the financial crisis. It operated from the 9th of December 2009 to the 5th of April 2010, a period of about 4 months. The BPT was imposed on banks and other financial institutions which awarded employee bonuses exceeding £25,000 during that period. The plaintiff in this case, Credit Suisse, was one of the banks on which BPT was levied. The court said this: the nub of Credit Suisse's case is simply stated. They say that the way in which the tax was imposed, and in particular the limited period of around 4 months to which it related, meant that in reality it was imposed only on those banks that, as a matter of practice, policy or expectation, awarded or were practically required to award bonuses during that period, taxed banks. Essentially, it targeted those with calendar year ends, bonuses generally being awarded around or relatively shortly after the end of the financial year. Banks with different year ends paid their bonuses at other times and escaped or largely escaped liability, untaxed banks. Credit Suisse say that this was a state aid measure because it conferred a selective advantage on untaxed banks who were in a comparable legal and factual situation, and that because it was not notified to and cleared in advance by the European Commission, it was unlawful. The court rejected that argument, essentially on the basis that the short period of operation of the BPT is explained by sound policy objectives. The court said this: taxed banks and untaxed banks were not in a comparable situation. The main objective of the tax was to deter bonuses being awarded during the 2009-10 tax year. That objective could, by definition, not be met in respect of bonuses awarded before the date of announcement, the 9th of December 2009. Such bonuses, and the banks awarding them, were in a different position from banks that had yet to award bonuses. As regards bonuses genuinely awarded after the 5th of April 2010, they were never the target of the measure. After the 5th of April 2010, there was a new income tax rate in force and regulatory changes were looming. I do not think that it matters that the regulatory changes were not in force until the end of 2010. They were viewed as sufficiently proximate to mean that, taken together with other factors, BPT was no longer required. Therefore, banks awarding bonuses after the 5th of April 2010 were again not in a comparable position with those awarding them during the chargeable period for BPT. For a copy of this case, please go to our website or app. The UK Upper Tribunal has decided a VAT case in regard to a purported decrease in consideration. The case therefore focuses on Article 90 of the EU VAT Directive, which says this: in the case of cancellation, refusal, or total or partial non-payment, or where the price is reduced after the supply takes place, the taxable amount shall be reduced accordingly under conditions which shall be determined by the member states. The taxpayer received fees for the sale of tax planning strategies, but contractually committed to refunding the fees if the strategies were unsuccessful, which they were. The taxpayer went into liquidation and it issued credit notes to its customers. However, cash refunds were never made. The taxpayer argued that due to the issuing of the credit notes, its price has been reduced, and therefore the taxable value of its supplies should also be reduced. The tribunal rejected that argument, applying a commercial reality test. It said this: the commercial reality is that there neither has been nor will be any refund of the price, or at least it cannot presently be demonstrated that there will be any such refund. We consider that that means that there is no reduction in price for the purposes of Article 90. The purported reduction is just a paper one in the circumstances, with no commercial substance. That means that no adjustment falls to be made under Article 90. The UK tax authorities have launched 2 public consultations. The first relates to VAT and is on the operation of partial exemption and the capital goods scheme. And the second consultation is in regard to the UK's implementation of the disclosure rules under the EU's DAX 6. You can find details on both consultations at our website or app. And finally, in regard to the UK, the government has decided to introduce in 2022 a plastic packaging tax as a result of a public consultation which was launched earlier this year. The government has now issued a paper which summarises the responses to the consultation and provides a description of the new tax. For a copy of the paper, please go to our website or app. In South Africa, the government has released for public comment a draft of the Taxation Laws Amendment Bill 2019, which will give effect to the country's 2019 budget. Public comments are requested by the 23rd of August. For a copy of the draft bill and explanatory memorandum, please go to our website or app. Uzbekistan will extend its VAT law to apply to inbound B2C digital services, effective the 1st of January 2020. In Brazil, the government has published a presidential decree which establishes a council to approve and implement Brazil's strategy to prepare for OECD membership. For a copy of the decree, please go to our website or app. In the US, the government has issued final regulations in regard to the allocation by a partnership of foreign income taxes to partners. For a copy of the final regs, please go to our website or app. Also in the US, a number of trade groups have written to Treasury Secretary Mnuchin in regard to the unintended tax costs which can arise under the GILTI rules due to the allocation of expenses for foreign tax credit purposes. As I've mentioned previously, those tax costs could provide a perverse incentive for US multinationals to conduct R&D outside the US. For a copy of the trade group's letter, please go to our website or app. And remember the recent Altera case in regard to employee stock options and a cost-sharing agreement? Well, the company, which lost 2-1 in the Court of Appeal's 9th Circuit on the 7th of June, has filed a petition asking for an en banc review by the 9th Circuit. An en banc review would involve 11 judges of the 9th Circuit. For a copy of the company's petition, please go to our website or app. And now for this week's treaty developments. We've had one treaty signed, one protocol signed, and one treaty enter into force. I have one article for you this week. It's called Argentina Updates Its Transfer Pricing Rules. It's written by Milton Gonzalez Mala and Pablo Godoy, and it's published in Bloomberg BNA's Daily Tax Report International. This article reviews the changes which Argentina has made to its transfer pricing rules to align them more closely with the OECD transfer pricing guidelines, with the intention of Argentina becoming a member of the OECD. In my view, the most significant change is in regard to the so-called sixth method. The authors write this: the sixth method required local taxpayers that exported goods with quoted prices, commodities, to related parties through an international intermediary to determine the Argentine taxpayer's income by using the export quotation price on the last day the merchandise was loaded for shipment, unless the agreed upon price was higher, in which case taxpayers were required to use the latter. The sixth method did not apply if taxpayers were able to demonstrate that their international intermediary complied with certain conditions. The 2017 tax reform repealed the sixth method and established a new requirement. Under the new rule, if the international intermediary is a related party of the Argentine taxpayer, or the international intermediary is a third party but transacting between related parties of the Argentine taxpayer, the Argentine taxpayer will have to prove that the remuneration obtained by the international intermediary is in accordance with the risks assumed, the functions performed, and the assets involved in the transactions. In other words, the tax reform requires the Argentine taxpayer to provide the documentation that helps to establish whether the remuneration derived by the intermediary is aligned with the intermediary's functions, assets, and risks. Well, that's the way it is this Friday, the 26th of July, 2019. I'm Steve Towers. Have a great weekend.